markets are looking very, very solid. Sanjay Parekh is founder and CIO at Sohum Asset Managers. Sanjay, good to have you back in the program. Thank you for joining us. Suddenly it looks just like that. It looks different, right? That's the beauty of markets. And Bank Nifty is almost at an all-time high. Although mid caps and small caps, etc., are kind of taking a backseat today. Those indices are up only 0.5%. Frontline indices like the Nifty Bank, etc., about 2% gains. Nifty is up 1.5%. I was looking through what you own, and we've discussed many of these names. Some are recent additions as well. Not that many, but a few are, right? Which had a bit of a swoon, and they are coming back very, very strongly. Pondi Oxides is the name that I recall. But what have you been doing, Sanjay? Give us a flavor before we get into individual names.
So it's been a roller coaster ride, and at least at the lower end, and we sent you a note as well that we realized that at 22,000 that it's overdone. But in such a volatile and chaotic world, it's tough to call a bottom. But all our balance sheets really were in good shape. RBI was very supportive. We saw rate cuts, and certainly I think what's coming out is that on a relative basis, we are much better placed in a global chaotic environment. And hopefully, it's tough to call. You all covered it so well that the China issue over a period of time should get resolved, because that will certainly will not be good for the world as well. So I think the recent discussions that we see that both of them slowly and steadily, it's still too far. They're too far away, but it should gradually resolve, and then back to sanity. At what levels they'll settle is yet to confirm. But I think markets are taking a hope that maybe things will get resolved soon. India, we were better placed, and I think this move, global FIIs, they started buying, possibly taking a cue that we are coming out to be quite a winner in this. Why we would be vulnerable on imports and dumping possibly from China, and export vulnerability also goes up, but we are definitely better placed in certain segment of EMS, or we see it as it comes in more sectors as well. And that is, I think, where this rally started, because we know that our earnings this quarter is going to be weak. But despite that, the only major reason I see is we are getting better placed within the world, and valuations in larger cap had got comfortable. That is at least my feel of what is happening in the market.
Hi Sanjay, good afternoon, good to see you in. Sanjay, most of exposures to large caps, if indeed the worst is behind, India is better placed. Do you think you'll look at at least keeping large caps as the highest exposure, but maybe incremental money going to mid and small caps?
Yeah, so always, last time also we discussed, we were never averse to mid and small cap. We only said that the margin of safety has to be higher. That is all. So we said that we will actually get opportunities in this carnage. And certainly, we added in a small way, but we did add one of them in small cap. So overall, we are still open to it. It's just that the environment in India is still tough in terms of earnings, and we need to have a higher margin of safety. So whenever there are opportunities, we are very, very open. We are overweight on large caps. The mandate is to have at least 70% large cap. We are today 77% large cap. But we are certainly open to looking at mid and small cap with a higher margin of safety.
Sanjay, hi, afternoon. Is IT approaching value zone to your mind for you to increase your exposure, large cap or mid cap?
We've been now 3 years underweight, 6.5%. Of course, we got hit when the IT did very well in the last few months, barring last month, again, it gave in. So, now the question what you're saying is absolutely apt, that we are also seeing that what is the implied growth and the current price. And now the implied growth is coming to be reasonable, at more like 5, 6, 7% long-term growth rate. But what is happening is the near-term pain also is there, and still we see the analyst estimates they're still at 5, 6, and some of them are now moved down to 3, 4%. But in a low growth environment, the return ratios are phenomenal, but growth is missing. So, how bad they can derate is even we are trying to question. In the last cycle, they did get further derated quite down. So we just watching it, remaining underweight. But at a point, you're right, there will be value and one can act contra, and we are positively looking at it to reduce our underweight, but not now.
Okay. Sanjay, hi. Good afternoon. I was looking at your portfolio. I think you're going to have a fabulous weekend, right? Because for viewers, banks are 31% of the portfolio. Diversified financials are another 7.8% of the portfolio. And the party here has really begun, Sanjay, hasn't it? I mean, and you've got everything out there. Axis Bank, HDFC, ICICI, even IndusInd, SBI, you've got Bajaj Finance, Shriram Finance. So I think it's a big party weekend for Sohum India.
Yeah, I mean, this week has been good. We did take our set of pain when they were underperforming. But banking, we had a conviction, and that's why we have an overall financial overweight. And we had this view of domestic overweight. And honestly, we didn't know it's going to be chaotic world. But all throughout, it was a domestic overweight, global underweight, which helped us. So be it transmission play, a telecom play, a tower, Indus Tower, or a power or utilities, or grassing through cement. All of it, or ports also, if the trade is going to increase from India, hopefully they'll also do better. So
no, Sanjay,
overall,
my question, allow me to just quickly dive a little deeper into financials because you have such significant exposure. Now, what is the story from here on? And you have everything, so you're absolutely fine. But if we try and narrow this down a little more, where will the earnings kicker acceleration, whether it's top line, whether it's margin, where will the kicker be felt the maximum? So where is the risk reward looking the best in financials?
the near term. The near term, as we know, the asset side repricing happens faster, the liability takes time. You will see actually pain on earnings in NII growth and NIMs. And with these 2 rate cuts, the repricing of asset side will certainly have a problem. But the other side is that when your repo rate cuts happens, the risk-free rate actually slowly edges down, and your price to book logically has to go up. So it's very logical, right? Interest rates going softer, your valuation has to go up. But for near term, yes, there will be challenge on growth. But structurally, I think, we have to see through this 1 or 2 quarters of pain on NII. And if you think the longer term, they're very, very well placed. It was always well placed, but it took some time before now it's starting. And the valuation, you see SBI even today is at 1.2 times, Axis is 1.4 times. You go up, SBI, even HDFC Bank after this move is 2.3, 2.4 times. ICICI Bank is 2.5. So when you see the Nifty, and then you see a clean book on price earning or price to book, they're still very reasonable. So we are positive, but having said that, near term, I think we will see some earnings growth challenge on NII.
All right, Sanjay, great conversation. Next one, we will get into some individual names here, but good run and a good showing. Thank you very much for joining us here on CNBC TV18. We'll take a quick commercial break here.